right, picture this. You're going about your day, and suddenly a massive breaking news alert flashes across your screen. It's about a major world leader. In that split second, you can almost feel the ground shift as global markets start to tremble. Today, we're going to dive into how these huge, out-of-the-blue geopolitical events can send absolute shockwaves through the currency markets. It's a heavy question, right? But it's one that every trader, every bank, every institution has to think about. Because when a powerful figure is suddenly taken out of the equation, well, the market doesn't wait around for the official report. It reacts instantly. And the stakes are just immense. We're talking about colossal, lightning-fast shifts of money that can reshape portfolios and even entire economies in the blink of an eye. So you've got to understand what's really going on behind the scenes. And believe it or not, it all starts with one single powerful human emotion. So let's get right to it. The big question: why do markets panic? You'd think it's the event itself that causes the chaos, but it's not. It's actually something much more fundamental, something that drives every single decision when a crisis hits. This right here is the absolute heart of it. If there is one thing the markets hate, truly despise, it's uncertainty. Suddenly, all these questions start flying. Who's in charge now? What happens to their policies? Is the country stable? And when there are no answers, the market fills that empty space with fear. And what does that fear create? Well, it's not a slow, orderly sell-off. Oh no. It creates pure volatility. We're talking wild, chaotic, unpredictable price swings as everyone scrambles to figure out their next move in a world that just got turned upside down. It's this volatility that creates those first powerful shockwaves. So let's trace the immediate fallout, and it almost always starts with the biggest player on the board, the US dollar. In those first few moments after the news breaks, it is just unfiltered panic. You see USD volatility go through the roof. At this point, traders aren't thinking about making a profit, they're thinking about survival. Their first instinct is to hit the eject button, to protect their money. And that leads to these incredibly erratic and dangerous market conditions. But here's where it gets really interesting and kind of counterintuitive. Your first thought might be, well, the uncertainty is in the US, so the dollar should crash. And it might, for a second. But then, as that fear spreads across the globe, what do investors do? They run for safety. And what's the world's ultimate financial safe house? The US dollar. So you can get this insane whiplash effect with the dollar moving sharply in both directions. And of course, this is way bigger than just a US dollar story. That initial shock doesn't stay contained. It immediately starts to ripple outwards, creating a massive global reshuffling of money. It's the classic flight to safety. When a crisis of this magnitude hits, investors pull their money out of anything that looks even remotely risky, and they pour it into assets that have a long history of being stable and secure. And these are the big three, the classic safe havens. You'll almost always see a surge into the Japanese yen and the Swiss franc, currencies from stable, neutral countries. And of course, gold, the ultimate store of value for thousands of years. Think of these as financial bunkers for investors just trying to ride out the storm. Now, it's a simple rule of physics, right? If money is flowing into safety, it has to be flowing out of somewhere else. And that somewhere else is anything considered a risk asset. So that means currencies like the Australian and New Zealand dollars, which are tied to global trade and commodity prices, they often get hit hard. Why? Because in a major crisis, everyone expects global trade to grind to a halt. The same goes for emerging market currencies. They're just seen as too unstable when the whole world is panicking. Okay, so we've seen the panic, we've followed the ripple effect, but let's get practical. If you're actually in the market when this happens, how on earth do you navigate the chaos? The most important thing is to have a plan before the crisis ever strikes. And rule number one, the golden rule, is simple. Do not panic. Trading. Making emotional decisions is a recipe for disaster. Instead, you immediately reduce your exposure, cut your position sizes, and shift your entire focus to one thing, managing your risk. Look, this is not the time to be a hero. It's not the time to try and catch a falling knife. The number one goal is just to preserve your capital. Honestly, if you can get through the volatility with your account still intact, you've already won. So after that initial shock starts to fade, the market will begin looking for answers again. The long-term direction is going to depend on what happens next. Who takes over? Can they project stability? What does the economy look like now? If calm and order return, the markets will recover. But if that uncertainty lingers, so will the volatility. So we're kind of left with this big question. In these moments of extreme shock, when fear is everywhere and emotions are running high, maybe the smartest play isn't trying to guess what happens next. Maybe it's just making sure you're still around to trade tomorrow. In a world this volatile, is survival the ultimate strategy? That's a question every single person in the market has to answer for themselves.